Welcome to Stock Talk with Niko'S. Today we're going to be going through why Niko's stock market checklist is important and why you should be using it. So this is the checklist I've created, okay? And this is just based off of things that I think are very important to look at when you're deciding whether or not to buy a stock. And I kind of have compiled this from all the things that I've researched over the past 5 years, from watching other people's YouTube videos, from reading articles, from just everything. These are the things to look for. So number one, why do we check to see if the stock is down or oversold? Well, just like the saying goes, buy low, sell high. That's pretty much all there is to it. And a lot of times when something is oversold, it just means that a lot of times, like if something is really, a lot of people sell based off of emotion. And so maybe they're not selling for a fundamental reason. Let's say the stock is trading at $40 billion, but it's worth 30. Well, let's say they sell it down to $30 billion, but with all that selling pressure, more people might see that and say, okay, well, I'm going to sell too because it's going down. And that pushes it down to 20, let's say. Well, then it's undervalued. That means it's oversold. So that's the first thing. The second part of this is the stock down. That means, like, let's say we check like Facebook stock or something. This goes with, it depends on which stock it is, because it depends on how big the company is and, you know, what type of company, what's the beta, how volatile it is. But every stock can fall to a certain degree. Okay. And most stocks they can fall 30, 40%. Some of them can fall, at least 50 or 60%. So a company like Meta Platforms, this is a bigger company. This is like top 10 in the world. And even a company like this can go from, let's use this. So this is 2018, it was $209. It went all the way to 124. So that's down, that's 40% drop. This was the pandemic, that doesn't count. This one in September, it reached a high of 382, and now we saw lows of 306. So even the biggest company in the world, Apple, a stock like this can also fall. So, you have a company like this that can come down 10 or 20%. And then you have companies like the Boston Beer Company that can be down. This company's down, almost 50% from last year. And so you just got to kind of know what kind of stock you're dealing with and how much it can fall. So that's the first reason we look for that. Next up, we have, why do we check for revenue and net income increases? Well, those are like two of the most important things to judge a business off of, because the whole point of having a business is to make more money and keep growing and getting more market share and make more sales, get more customers. That's the whole point of it. So that's why you want to make sure the revenue net income is increasing, the company's showing progress, and they have something to prove to the shareholders that's saying, hey, this is why in the future we're going to be worth more because we're making more money and we're selling more of our product or service. Net income, that's the same thing, just maybe it shows that the profitability or the efficiency of the company is getting better. Next up, why do we check for price to sales and price to earnings? There's tons of different valuation metrics like the PEG ratio and price to book. There's tons of different ones, but these are two of the most important, really going based off of what we just talked about, revenue and net income. That's what these are associated with. Healthy price to sales just means the price you're paying to buy the company relative to the amount of sales or doing sales as revenue. And then forward price to earnings means the price you're paying for the company divided by their forward earnings. So whatever next year's earnings are going to be, next year's net income, that is how you get the forward PE. And so we want the PE to be healthy. We want it to be low enough because, and this ranges for all types of stocks. So if we look at a company like, let's see, US Steel, I think this is a low forward PE company. You think of the lower the price, the better, the cheaper it is, the better, but that's not how it works, because it's relative to the stock. So it's relative to the type of stock it is too. So for growth stocks, it's way different. For a Shopify, a Tesla, a Palantir, big companies that are growing 30, 40% a year, those are going to trade at much higher multiples. They're going to trade at a forward PE of, let's say, it could be 100, it could be 200. Shopify was 1,000. It's at one point. Price to sales, it could be, it could be a 20, it could be a 30 price to sales, which is insanely high. but that's how those companies are going to trade. Amazon for the last 10 years has always traded at a rich valuation. The PE has always been above 60 when the average PE in the market is like a 20. It's a 20 right now. So, but let's look at this case. United States Steel, forward PE of 1.6. That's pretty much as cheap as you can possibly find in the stock market. Price to sales of 0.35. That's practically nothing. That means they're doing pretty much so $39 billion. The company's valued at right now. And let's see, this is in a different currency, I think, but the point here is that they're going to be doing as much more in revenue than the company's is worth. It should be. Let's see. No, okay, so this is this is different. But the point is, another thing you got to look at is how much are they expected to grow. So like one thing I like to look at with the price to sales is whatever the price to sales number is, if you want to get it at a good deal, the amount in revenue they're going to grow next year, which I'm going to show you that number in a minute. This is a bad example. That number should be twice the price to sales. So if the price to sales is a 5, that means you want the revenue increase percentage for next year to be at least 10%. So watch, I'll show you an example. Palantir. This is a faster growing company, big valuation, forward PE of 93, price to sales of 25. That is incredibly high. Now, based off of it, it's been a 40 in the past. So it's definitely come down a little bit to healthier levels, but 25 is still rich. So a price to sales of 25, we want at least 50% revenue growth, which that's pretty hard to find. They're doing 30% revenue growth, which isn't bad, but you're paying up for this company. But that's why we look at price to sales and price to earnings. Next up, innovative or remote. This is very important just to, give the business its edge, make sure it stays away or stays ahead of its competition. And if the company is innovative, that means they're making new products, they're doing new things. Tesla is an innovative company. They made electric vehicles popular. A company like Coca-Cola, probably not very innovative. They're just doing the same thing they always do. And then the moat is, do they have something in their business that's hard to replicate? So like that could be like Qualcomm has certain patents that not anybody can take. They get royalties for those patents. Okay. Another moat I count sometimes is just if they're number one in their industry and they have a huge if they own the majority of the market share, then that's hard to replicate. If they own half the market, that's not an easy thing to take over. But with most moats and stuff, the other competitors can normally steal away their moats, but it's not easily replicated. So it's something that takes a while, could take years or tons of money to replicate. But yeah, that's why we look at that, because that is something that will keep that business ahead of other businesses, and that will help that stock price out. Is the industry growing? This is a very important one, because you can look at all the other metrics. If a company has all these other metrics spot on, but they're in a dying industry, well, that doesn't make any sense to be in that industry or be in that stock. So let's say something like recently I was researching the cannabis industry and sports betting industries. Okay, both of those are two newly hot things now that are growing very fast, and they're only half the country, only half the United States has those industries legalized. Okay, only half the states even allow that. So that means this has the potential to the industry can double over the next 5 years, 10 years, whatever. But yeah, so it's not just about how healthy or how great the company is or how great the stock valuation is. It's also in that industry that they're in, is it growing? So you don't want to buy a company that's in a dying industry. This could be a tough example, but like just things of the past, like of a company like a lot of people think Intel is in the dying business, or IBM. It's companies of the past that they had technology in the 70s or the 80s, but now things are different and other companies take over. Next up, return on invested capital. I've seen people say like analysts and stuff say that the biggest thing that stock price that determines the stock prices are the return on capital and the amount of capital they can invest. So they're saying like a company like Apple they have tens of billions, if not $100 billion plus worth of capital that they can invest. Okay, and their return on invested capital is normally around 40%, which is incredibly high. Most companies get like 5%, 10%, and so that's why Apple is the biggest company or the biggest stock in the stock market with their market cap's over $3 trillion. There's other things, like they say Tesla, their return on capital, it was around, it was negative a couple of years ago, but then it got to 10%, 15%. I think right now it's right around 15 or 20%. And they're saying, if Tesla can get to 40% return on capital, then they have the potential to be the biggest company in the world. Maybe they're going to have a $5 trillion market cap. That might happen in a couple of years from now. But that's why we look at return on capital. It's pretty much the same thing as judging an investor based off of their return. So like the way I kind of look at it too is I think the benchmark is 10%. I feel like that's a good number to base it off of. If it's under 10%, that means they're probably underperforming. Over 10% is very good. And how I just said 40% is like on the higher end of things. But I mean, you want the company, think about this. If you want the stock to outperform the regular indexes, and the indexes average 10% a year, that means that company needs to be getting at over 10% return on capital if we want to see the stock grow over 10%. Then we have healthy margins. This is just another thing, it's kind of like tells you how efficiently they're running the business. Are the margins improving? What's the gross margin? What's the operating margin? What's the profit margin? So like, especially the profit margin, that's the most important one. I mean, this doesn't entirely determine, this isn't an incredibly, like, let's say a company like Amazon, they're one of the most successful companies, but their profit margins are only what, 3%? I think it's 3% or 4%. It's super low, but since they have so much volume, it makes up for it. And that's why it does that. And then you have other companies that have huge profit margins that can be like 20% or something, 20%, 30%. Those are huge. Those are big profit margins. And, then that helps them out. It gives them more leverage, more room to, whatever, distribute cash, whatever they want to do, buyback, give dividends out, whatever they're trying to do. Next up, diverse revenue streams. This is another important one because let's say a business has let's say Facebook. Facebook has Facebook, Instagram, the Messenger, WhatsApp. They have Oculus. They're working in the metaverse. They have advertising revenue. They have all these different things. Okay, compared to a company like Snapchat. Snapchat all they have is the Snapchat app. That's the only thing they have. So they make money from that, but that's the only thing. So if you have diverse streams of revenue and you're in different types of businesses, you have different ways to make money. If you have a bad year in one part of the business, then it doesn't completely ruin the business. You still have other sources of revenue coming in. And so that's why we want that. It's just a safer, it's a more balanced approach. And it also creates more opportunities in the long term for just to keep increasing revenue and net income. Then these next three are about the balance sheet. Balance sheet is very important because you don't want to be in debt. The debt makes the company look bad. If the equity is shrinking, that decreases the value of the company. That doesn't look good either. And then you also want to have, especially cash and short-term assets, have that be at least twice the amount of debt and short-term liabilities, because then the company can pay off debt, make acquisitions, pay dividends out to shareholders, whatever they're trying to do. And if there's a bad year where they don't make a lot of money or the economy goes bad for a year or two, then it's important to have that cash on hand so they can still function. And the other thing too is, like, a lot of companies have bad balance sheets. Like in the pandemic, when the world shut down and some of these businesses did not have good balance sheets, that's when they also have to raise more capital by issuing more shares, and then that dilutes shareholders and you lose money. So that's another reason why you want to have lots of cash on hand. Share buyback and dividend, kind of the same thing. Share buyback means the company is reinvesting into itself, buying back more shares. That's a good sign. That increases shareholder value. It shows that the company is confident in their future and they're making smart decisions. And it also will help with the stock price increasing. If the company is issuing more shares every year, like a lot of unprofitable companies do, or smaller growing companies, then that's going to dilute shareholder value. So a company like Virgin Galactic, they issued a bunch of shares, or Teladoc Health, they're both unprofitable companies. That's why those stock prices have gotten killed over the last 6 months, because they issued all those shares and the share price is now only worth half of what it was before. Then the other thing too is a dividend. The dividend is it's another plus side to owning the stock. The average dividend is like a 2%. So if you can find one that's 4% or 6%, then that's very high, but it's not just about the dividend number. It's also about the payout ratio, which is just as important, meaning looking at what percent of their earnings, of their profits, are they paying out in dividends. Because if the payout ratio is 200% and they make $100 for the year, but they paid out $200, well, that doesn't look good. That means they're losing money and they're using debt to finance that. That doesn't look good. And so either I put that in the same category, because if they're buying back shares or if they're paying a dividend, it just shows it's two ways to reward the shareholders. So that's another important thing to look for. Finally, we have this big money interested. This isn't a make it or break it criteria, but it's something to look out for, because if there's big companies like Vanguard, BlackRock, ARK Invest, if there's big funds investing in these companies, that is a good sign, because if they're putting billions of dollars in these companies, then that's going to keep the share price up. It's going to make it more of a trustworthy stock. And it's also that's also how you get stocks to move up in big ways. If you want, especially the smaller the company, or the bigger really, if it's a small or big company, if you want to add $10 billion or $50 billion in market cap, you're not going to do that with regular retail investors. You're going to do that with hedge funds who are investing billions and billions of dollars. So yeah, those are the reasons I have all 16 of these on my list. And that is why you should be using those every time you value a stock.